Imagine a magical stock that holds the value of an entire market. That's what an index fund does, but with less risk and more stability. An index fund is like a big basket that holds many different stocks or bonds, representing the whole market. It's designed to mirror an index like the S&P 500. The S&P 500 tracks the performance of 500 large-cap U.S. companies, making it one of the most widely followed indexes in the world. Active fund managers try to beat the market, while index funds simply match its performance. Active funds often charge higher fees for this extra effort. An index fund buys a set of stocks based on an index. When the index changes, so does your portfolio. This process is called rebalancing. Index funds were introduced in the 1970s by John Bogle, founder of Vanguard. The first index fund was the Vanguard 500 Index Fund in 1976. Over the long term, index funds have outperformed actively managed funds. For example, between 1980 and 2020, the S&P 500 returned an average of 10% per year. A $1,000 investment in the S&P 500 at its inception in 1957 would be worth over $3.6 million today, thanks to the power of compound interest and index funds. Think of an index fund like wearing a life jacket. You won't always be the fastest or most agile, but you'll stay safe and float. While it's true that index funds can't predict market movements, they do consistently match or beat the performance of actively managed funds over time. Are you looking for a way to invest that's easy and straightforward? Index funds are designed to track the performance of an index, like the S&P 500. This means you can get market returns without trying to beat it. Think of an index fund like a huge collection of every coin in circulation. It covers the whole market, not just a few rare pieces. This ensures you have exposure to every sector and company. Imagine a group of investors holding hands, forming a steady line. Each hand represents an investor in an index fund. Together, they form a stable structure that resists the winds of market volatility. When you invest in an index fund, the cost is minimal. Compare that to actively managed funds, which can be significantly higher. This makes index funds a cost-effective way to invest. The journey of index funds began in 1975 with the creation of the first such fund by John Bogle, a pioneer in passive investing. Over time, these funds evolved to include popular indexes like the S&P 500. And by 2010, they had grown to manage trillions of dollars globally. An index fund mirrors the performance of a specific benchmark, such as the S&P 500. It holds a diversified mix of assets to match the index, rebalances annually, and operates in a passive manner with minimal management. Investing in an index fund is straightforward. Start by choosing a provider, select the right index to track, open an account, and monitor your investment. Reinvesting dividends can help grow your portfolio over time. Yes, index funds have fees, but they are typically lower than those of actively managed funds. For example, the average expense ratio for an index fund is around 0.1%.